So we just talked about how to make balance sheet and income statement. And there are two other statements, statement of cash flow and statement of shareholders' equity. And for those two accounts, you can just look at it on your own. Those are not the emphasis for this chapter. For the statement of cash flow, one point I just want to make here is there are two ways to make statement of cash flow, direct method and indirect method. And the way we're using here on our solution, that's we're using the direct method, which is basically we break up the firm's T account, the cash T account, and try to look at each of the transaction, whether it is operating related, investing related, or financing related, and to put them into each section of the cash flow statement. But for that, you can look at it on your own. And then the next step is to prepare closing entries. So closing entries, we have three closing entries. First, we need to close out all of the revenue accounts to income summary. So debit sales revenue, 40,000. Debit interest revenue, 100. And credit income summary for 40,100. And then we need to close out all of the expense account to income summary. So we debit income summary and credit cost of goods sold for 22,000. Credit salary expense for 7,000. Credit utilities expense for 2,000. Credit interest expense for 250. Credit depreciation expense for 500. Credit rent expense for 3,000. So all of those sum up together, that's 34,750. So that's the income summary. And then the last step is to close out income summary, because income summary is also a temporary account. We close it out to retain earning. Debit income summary. So as you can see here that now income summary. So if we make a T account for income summary, it first had a credit balance of 40,100. It is credited for 40,100. Then it is debited for 34,750. So the balance is at the credit side. And in order to make the balance of income summary go to zero at the end of the financial reporting period, we need to debit it by 5,350. And after that, it will have a zero balance. So, and then that general entry is to debit income summary by 5,350 and to credit retained earning by 5,350. So that's how retained earning has a balance of 4,350 at the credit side. So, and then after this step, the next step is to prepare post-closing trial balance. So the post-closing trial balance is basically we close out, we post all of those closing entries to their respective T accounts. And after those closing entries, all of your temporary accounts should be closed out to zero. So you don't have any balance for your temporary account. the only account that has balance will be your permanent accounts. So let's write this trial balance again. Account, debit, and credit. So we have cash, 22,000. Account receivable, 25,000. Prepaid rent, 3,000. So basically all of your temporary account, almost all of your permanent account except your retained earning will be the same as before. Your retained earning will be different and all of your temporary account will be gone. Inventory, 16,000. Interest receivable, 100. Note receivable, 20,000. Equipment, 20,000. Accumulated depreciation, that's 500. Accounts payable. So accumulative depreciation, that's a contra account to your equipment. That's a contra asset account. So that's why the balance is at the credit side. Accounts payable, 20,000. Interest payable, 250. Note payable, 30,000. Common stock, 50,000. Retained earning, 4,350. So if you calculate the sum of the balance at the debit side, that would be 105, 100. The sum of the balance at your credit side will be the same number. So those two numbers should equal. Yeah, so this is your post-closing trial balance. As you can see here that all of the temporary accounts are gone. So that's all for this example.